Good morning, peeps. Well, Friday, what a day! Rather cataclysmic, really. As I've sort of said in the fundamentals piece, certainly some major moves in the bond market and in the stock market with the inflation. We said on Friday that the market is zero hedge. We're expecting that the market would bounce. On Friday. It certainly wasn't the case with the 2 months in the last 2 years where it has printed less than expected, and CPI has risen for 14 straight months. So it's certainly the market got smashed in the stock market, and there's a bit to unpack in that. But I think with the spike in volumes as well, that we're going to see this sell-off continue, and we can see that in the overnight futures market this morning, the S&P is breaking lower again. It kind of reminds me of the Justin Mamas's risk sentiment cycle. Returning confidence, enthusiasm, disbelief, then panic, discouragement, wall of worry, aversion. That cycle tends to repeat itself quite often. And if we're looking at the S&P 500, to me, where this is the disbelief, right? Obviously, that's the enthusiasm, that's the returning confidence. This is the kind of denial and the market exuberance, right? So we're not. I think we're looking at this section here. That's what this is, and so we've got a bit of panic to come into the market, and certainly if it breaks below that low at sort of 3,800, that's what we'll be looking for, is that panic sell-off. And kind of hard to jump on the bandwagon right now, but so to me this is the disbelief section. This sort of over here is this area, and now we're at this part, which is here, and we're looking for the panic to come. And as US look to raise interest rates, which they're expected to do this week, we've got a pretty busy week. FOMC on Thursday morning Australian time, S&B, BOE. S&B is not expected to raise rates, but BOE and the US are. So Thursday's a very busy day with Aussie unemployment thrown in there, but with the Fed raising interest rates, you would be looking for that sell-off to continue, because you've got bonds paying a yield of over 3%, which is kind of handy compared to the dividend yield. So US bonds are over 3% now. German bonds spiked as well. So markets certainly had a very interesting Friday. Commodity markets peeled off a little bit. The commodity index here at all-time highs. The Bloomberg Commodity Index back up at its all-time highs. In fact, I think it made a new high last week. Oil's coming off a little, but the safe haven, which is gold here, had a massive bullish engulfing day, closed above the sort of recent highs, and I'll be looking for that safe haven of people trying to protect their asset values to continue. Otherwise, commodities weren't the major story. They were pretty much subdued. I'll come back to indices in a minute, but we've got copper, oil and Brent off a little bit. Gasoline, even natural gas is a little subdued on Friday, where all the action and activities were certainly in stocks and bonds, and as a default, the US dollar. So global stocks, just looking at the Nikkei, we took this trade as we were talking about it last week. That got triggered in and hit our target, and it certainly has gone straight through our target and carrying on. And I'd be looking for the Nikkei to sort of maybe, don't know about this week, but certainly we'll be getting down to sort of I'll be looking for the S&P to get down around these levels here, maybe this week sometime. That's the Nikkei. S&P 500, well, as I said, if it gets through 38 on Thursday after the Fed meeting, probably looking around that level there as your first initial level of support. And yeah, tech stocks probably the worst performers, I would suggest, because they're more of a growth asset than a value asset, so people will unload those pretty quickly. And we are noticing a bit of fear coming in. It's not panic stations yet, but it's certainly the fear indicator, which is the VIX, is starting to push up, and anything sort of above 20 is people starting to get concerned. But you go back to 2008, that was, well, that's 2020, pandemic highs, it was up at the 80s, so certainly anything back into the 30s, and you would be expecting panic starting to hit the market, certainly heading that direction now. And so with the movement of bonds, you've certainly got that US dollar strength. So this is the dollar index, which is a basket of currencies, predominantly Europe, but also a basket of all the majors. And we can see that we're back into this new leg lower. Yen is 20-year highs, hasn't been up here since the early noughties. Cable starting to move now, and we can see that US dollar theme is there and should probably continue. However, as I mentioned in my fundamentals this week, I think the US dollar, well, certainly as a safe haven, the US dollar is the go-to at the moment. But I think that as the panic sets into the stock market, that will broaden out, and people will look at other assets, not just US dollar. They'll be looking at gold, and if you go and have a look at the potential of Aussie dollar and the Kiwi dollar, when you look at their rates, overnight rates, and the 10-year and the Kiwi is 4%. Stable economy, stable political scene, and you're getting a 4% yield on your 10-year. And Australian 10 years are 3.1 or 3.2%. Also stable political arena, reasonably stable economy. So there might be a bit of a bid coming into these currencies, over the next maybe week or two, or even a longer horizon. I just don't expect the US dollar to get all the attention for the safe haven. As stock markets become a bloodbath, I would expect that safe haven bid to broaden out into other bond markets, not just the US. In terms of looking for a trade today, it's going to be pretty difficult. There'll be, well, this week I think as panic starts to set in, there'll be a lot of volatility and knee jerking, and kind of jumping on the bandwagon. There's more FOMO trading, fear of missing out. But there should be opportunities in the shorter time frames. If you look at sort of 1 hour or 5 minute, that's my euro dollar trade from a while back. When was that? Start of the month. Hit target on Friday night. Yeah, over exhausted on the hourly, but you'd look for a bit of a pullback to come and fill this sort of gap in, and look to get short there. May not get that. Sometimes you don't. Sometimes the gap that's created doesn't come and get filled, but does get tested. So it might come and test that level there. But that's unlikely in this kind of scenario. So look for opportunities on the shorter time frame this week. I think trading on the daily is probably going to be more high risk than trading on the shorter time frames. Okay. Thanks, guys. I'll be back tomorrow. Cheers.